Hello, everybody. This is the Shreya, and today we'll be talking about a small topic under the financial derivatives and risk management. And the topic would be commodity futures. Now, to start off with the meaning of commodity futures, what exactly does it mean? So, commodity futures are financial contracts that obligates a buyer to purchase and a seller to deliver a specific quantity of commodity. And this commodity could be gold, oil, wheat, or natural gas at an agreed upon price as on a future date. And these contracts are specifically traded on organized commodity exchanges such as the Chicago Mercantile Exchange or the Intercontinental Exchange, and they serve various purposes for both producers and the consumers of commodities. So, this is what commodity futures mean. So, now let's move on to the benefits of the commodity futures. So, to start off with, we have the price discovery. The commodity futures market plays a very crucial role in determining the fair market price of various commodities. Uh, Prices are determined by the forces of supply and demand present in the market, and the information generated through futures trading helps participants make informed decisions. So, we can say that we have a fair market price determined at the end of the day due to demand and supply present in the market. And the next we have risk management. So, one of the primary benefits of commodity futures is risk management. Both producers and consumers can use futures contract to protect themselves from adverse price movements. For example, a farmer can hedge against the falling crop prices, and a manufacturer can hedge against rising raw materials. So this is one way where the commodity futures market helps mitigate risks. Up next, we have liquidity and flexibility. So, commodity futures market are highly liquid. It allows traders to enter and exit positions very easily, and this liquidity provides flexibility in managing exposure to commodity price fluctuations. Hence, it allows the participants in the market to to deal with assets which are to deal with commodities which are highly liquid and gives gives a much larger exposure towards price fluctuations. And speaking about speculation, now speculators are those who play a vital role in commodity futures market. uh, and how? This is by providing liquidity and absorbing risk. Now, they also have the opportunity to profit from price movements without direct interest in the physical commodity. This is how the speculation acts as a benefit in the commodity futures. And we have portfolio diversification, of course. Commodity futures can serve as a diversification tool for investors. um, they have very low correlation with traditional asset classes like stocks and bonds, which can help reduce the overall portfolio risk. So, this is about the benefits of the commodity futures. So, now let's talk about pricing commodity futures. So, commodity futures prices are determined through the interaction of supply and demand on the commodity exchange. So there are various factors that influence these prices, and let's take a look at it. So the first one being supply and demand fundamentals. So the most fundamental factor is the relationship between supply and demand for the underlying commodity. So changes in factors like weather, production, geopolitical events, and consumption can also influence these fundamentals. So this is one way that the pricing takes place for commodity futures. And up next we have interest rates. Now the interest rates can impact the pricing of commodity futures. How is the question? So, a higher interest rate can increase the cost of uh, carrying a futures position, affecting the future price. So the higher the interest rate, the more it affects the futures price. And uh, this is another pricing strategy that is used for commodity futures. And up next we have carrying costs. Now these costs include storage, insurance, and financing expenses associated with actually holding the physical commodity until the date of delivery. So these costs are also influenced or reflected in the futures price. This is how carrying costs play a role in the pricing of the commodity futures. And one another way of pricing commodity futures is market sentiments. Now, the market participants' perceptions and expectations about the future supply and demand can influence futures pricing. So, factors like economic indicators, geopolitical developments, or news, they all play a vital role in determining the price. And it mainly depends on the participants of the markets, their perceptions and expectations, um, and the demand that can influence the future prices. Uh, at the last but not the least, we have arbitrage opportunities between the futures and the spot market, and these can also affect pricing. Traders may exploit price differences to keep the markets in line with each other. So these are the ways the pricing of the commodity futures actually take place. So the last topic for this video would be hedging with commodity futures. So to start off with, we have two types of hedging, that is perfect and imperfect hedge. So let's start off with perfect hedge. A perfect hedge is a strategy in which a market participant uses commodity futures contract to eliminate all the price risk associated with a physical commodity position. For example, let's say there exists a wheat farmer who sells wheat futures contract for the same quantity of wheat that they intend to harvest, and this creates a perfect hedge where the price risk is completely eliminated, and the price movement in the physical commodity and the futures position will offset each other, resulting in a known fixed price for the wheat. So this is about a perfect hedge. Now, talking about an imperfect hedge, on the other hand, it does not eliminate all price risk, but it works on reducing the risk. So, this strategy involves using future contracts that usually do not perfectly correlate with the underlying commodity, because at the end it leads to some amount of risk. There is an exposure for a little risk. And let's take, for example, there's a bakery that buys wheat futures contracts but doesn't perfectly match the contract's quantity with its requirements, and that has an imperfect hedge. So this approach provides partial protection against price fluctuation, but it'll still leave the company exposed to some risk if the futures and the physical market prices do not move in perfect harmony. So this is about perfect and imperfect hedging. But if I have to conclude the entire video, I'd like to say that commodity futures are a very essential financial instrument that provides numerous benefits, including price discovery, risk management, liquidity, flexibility, and speculation opportunities, like we've discussed already. And pricing is influenced by supply and demand, interest rates, carrying cost, market sentiments, and arbitrage opportunities. And like we just discussed, hedging can be done through perfect hedges, which eliminates all the price risks, or imperfect hedges, which reduces the risk but does not completely eliminate it. So That's it for today's video, and thank you.